Hello, this is Manash Patel with IMTF Trade. Today I want to talk to you about the U.S. market. We're specifically going to look at the E-mini S&P 500 futures. We've had a lot of volatility in the market, which is expected for September and October, believe it or not. We talk about this in our trading room, in our weekly sessions with all our students, that it was going to happen, it was going to happen soon. And it did happen this week. And you could see it very easily. Here's a 4-hour chart of the E-mini. We look at the 4-hour reason why. This is the bridge between swing traders and long-term traders. Believe it or not, this is the best time frame to trade. If you see a signal on this, then you got a high probability of it starting a trend, which goes from swing trading to long-term. But either way, you see these black crosses here, they represent multiple time frame support resistances. In other words, what does that mean? You probably heard of Fibonacci. Fibonacci has been the most key technical thing that's used in trading world today. In fact, we put out a Fibonacci video years ago and it's still very popular. Imagine doing Fibonacci on multiple time frames, and that's called Fibonacci clustering, where you look at all the Fibonacci levels on different time frames, and when they can sit there and converge at certain points, a certain price level, that's what we call a multiple time frame Fibonacci level. Well, we've done all that work for you. You've taken the subjectivity of Fibonacci, taken it all out, and that's what these black crosses represent. You could see here this floor of black crosses here. And what you're looking for is a break. You could see this red bar here that signals a possibility of it going down. It had a chance to go up, especially after this volatility spike right there. It did not do that. It's been holding. So now what we're doing is we see this red bar here. Once we see that red bar here, it has a cross below it, a multiple time frame support. So what we're going to do is we're going to set up an order to go right below it. And that's exactly what we sit there and show our students every day. Take these multiple time frame levels, take a level below it, a couple of points below that level right there at the end of that bar, put a stop a couple of points above that high right there, and you sit there and you enter on this bar. So at the beginning of this bar right here, right there, you put an order a couple of points below it, your initial conditional stop above it right there, and you bet on this instrument going down. We entered. If we didn't enter, you cancel. You entered here and you're profitable. Our key money management is on the first bar that you enter, you have to be profitable. On the second bar, you have to be more profitable. If you're not, then you basically get out of the trade. After 2 bars of being profitable, we change our stop to being break even. So this bar here, we entered here. At the end of the bar, we're profitable. So that's good. Second bar here, we close more profitable, which is good. Now we change our stop to break even. This is a risk-free trade. You're going to keep on taking this down, keep on taking this down. You're always looking for a minimum of 3-to-1 reward risk ratio. And you could see here, we got our 3-to-1 roughly right there. Now, how far will this be going down? That's a magical question. Well, our stop is at break even. There's no risk in this trade at all. What you're looking for is a black overextension dot right there. Once you get that, now you start using a trailing stop, which is a previous bar high. So at the end of this bar, you got a black dot, use the previous bar high. Here, you're still using the previous bar high, and you get stopped out right there for a profit. So boom, you got stopped out for a profit right there, and you took in 360% reward risk on this trade. It's as simple as that. That's it. That's all you're looking for. So here you could see a wall of support. We're looking for it to break it, because once it does, that's a multiple time frame sell, and exactly what you see going down. This is big money controlling this going down. You're now trading like an institutional trader, where you're keeping your risk low, looking for 3-to-1 reward risk ratio, and you're playing the probabilities with high. If you have any questions, you could email us at info@eiicapital.com. Thank you. Goodbye.